For our parents and grandparents, retirement planning was never a big thing on their minds. They just used their corpus to invest in a fixed deposit or other fixed income products and lived off the interest income happily. But today, life has gotten complicated for most of us, looks like. Our lifestyle is constantly demanding more and more money. Services inflation, on the other hand, is making it more expensive to live. And to top it, life expectancy is going up, which means most of us are looking forward to living to 85, 90, and even more than that. In fact, I recently attended a 100th birthday celebration last week where the grand old man was happy, hale, and healthy. This brings the question on savings for retirement. How does one actually navigate savings for retirement? And how does one effectively deploy the post retirement corpus so that we maintain that quality of life which we have always lived, which we look forward to living in our retirement years? And is fire possible with all these challenges? What is the secret sauce to attaining financial freedom and retiring early? To discuss all this and much more, we have Shyam with us here today in the next episode of Decode. Hi, Shyam. So, we've been thinking of retirement planning in a very simple way, I feel, for a lot of generations until now. So, a lot of people thought you have a retirement corpus anyway when you come out of your workplace, and then you must have made some investments. You put it all together, put it in a deposit, and then you get 7 8% interest. And now there is this advantage of having no tax on income up to 12 lakhs also. So interest up to 12 lakhs is essentially 1 lakh a month. And, life seems sorted. Is retirement planning that simple?
See, at today's context, you feel comfortable with 12 lakhs.
Yeah.
But you also know that this 12 lakhs adjustment has come after how many years? Almost a decade that you have come to this level. So, as inflation increases your cost of living, I don't expect that the exemption limit to go up to give you that comfort all the time. So, that comfort is not something you can take for granted. That's my first point. That you can remain below the radar on taxation and still meet your monthly expenses at the current levels for a long period of time. That is not an easy assumption to fulfill.
Yeah.
Also, your lifestyle is generally kept in check until you retire. Most people don't have time to even spend money. So, they start living their own life only after retirement. So, the cost of living which you think is enough to run your life in your 50s probably may not be enough in the 60s because your aspirations start playing out. You want to travel, you want to go see the world, you want to be with your children who are not here, who may be in another city or another country or another continent. And you also want to do a lot of other things. You want to spend on yourself. Many aspirations come into play. So, the money on which you are going to live in those 20, 30 years of retired life should be enough to meet all these things. For that, you need clarity on what is going to be your post-retirement life. How is it going to look like? So, you need to visualize how you are going to live. Most people try to reduce this and say, oh, I don't need anything. See how I am living, stuff like that. Without taking into consideration what is the aspiration of the partner, aspiration of the children, what is the aspiration of the peer group. If all your friends after retirement want to go on a pilgrimage, will you be able to say, I don't have money, therefore I am not coming?
Yeah.
Will you or your partner be able to say that to that group? It won't look nice, no?
Yeah.
So, you need to actually envisage what is the life you are going to lead. Suppose you are going into a retirement community and living, which is today a very popular idea.
Yeah.
Can you live at a standard of living which is lower than what the average person there is living? Whereas living in the city, you could have done that actually. But when you go into a community, you would like to live by the community standard of life. So, a lot of things are coming into play. So, just saying that, okay, if I have 1 crore, I'll get 8 lakhs deposit money and I live off that, probably may not hold good for a lot of people because the aspirations are much higher.
Yeah.
So, when you say retirement planning, fixating yourself just on that 1 crore, in my opinion, maybe too cramping. It will restrict you a lot. And as you grow older, if you get some health issues and other things, that restriction will become even more, because sometimes you will have to reduce your capital to meet some of these expenses, which may or may not be covered by insurance.
True.
So all this can be narrowing your life as you grow older and not giving you the quality of life you had in your earning years, which is not likely to be anybody's professional aspiration or anybody's personal desire. So you want to do much better than what you are doing today when you retire, because that's the time you're giving to yourself. So you need to make money work for you to the extent that you're able to give yourself whatever you want, what your peers are enjoying, and you'll have to maintain a certain standard of living.
That's true. So 2 questions emanate from this conversation. Number one, so you do have aspirations, we do understand that services inflation is very high and you must be able to meet it and all that. Now there are 2 things which come into play. Number one will be savings, beginning your savings early on for retirement. Typically what happens is this aspiration means that you should start saving probably as soon as you start working.
Correct.
And all that. But you have, when you start working, this goal may be about 30-35 years away.
Correct.
But you will have a lot of goals in between to meet. And always maybe the goals which precede that might take priority.
Correct.
So how does one manage the savings towards retirement?
See, any goal, if you start at the right time and give it enough time, will take less of your money and give you more of the needed capital from compounding. This applies to any goal. I'll give you a simple example. When do people start saving for a child's education? When do you start? Usually, generally, when you see people, when do they start? They start around the time the child is in high school, getting ready to go to college. Mostly, either in high school or college. I believe that you should start saving from the time the child is born. So what happens is that your entire education can be met with a significant compounding component. Compounding can be the biggest driver of your child's education. 99% of the people fail to do this. They don't invest from the time of birth and allow compounding to play. So when do you begin? Ideally, you begin earlier than everybody else is doing. You begin earlier than people tell you this is the right time. And you give yourself more time by doing so. So this is the playbook that I think most people lack, or this is the playbook which I think most people should give themselves. When you do this, if let's say you have 5 goals, or all 5 goals which are going to come well before your compounding, including maybe a marriage of a child, because that's a big ticket item, education, higher education, then schooling, then you're buying a house, maybe buying a second house, maybe investing in some agricultural lands, buying cars. For every single goal, if you are the type who is going to save, compound and then meet that goal, what would happen is compounding would have saved a lot of your present income in all your big ticket items of expenditure. So what happens is, on the one side compounding is taking care of you, on the other side compounding is giving you some extra money also, which again you don't disturb and allow it to compound. When you do this, then what happens is that you meet every goal from compounding. Mostly. So this is the playbook that I think people should make a way of life.
So the other question that I had from your earlier answer was that we do understand that there is inflation and that there is a certain life expectancy again. Today, medical advancements make people live over 90 and so on and so forth. So you have these expenses which have to be managed. Now, these are 3 variables which come into play when you plan for retirement. And when you use some calculators, or typically when you go to advisors, most people arrive at a very intimidating number. Now, how do you, and if you tweak these variables, sometimes you will get a baseline number also. Now, how do you arrive at a very practical but yet not intimidating number for your retirement corpus?
Firstly, the number is many years away. If it is many years away, then you should not get intimidated by the number. Because when a number is many years away, your compounding is what is going to meet that number, not your own annual savings alone. So you have to get that right, that's all. You don't have to worry about the absolute number. Let's say, there was this, people are asking me whether they should need 20 crore, 40 crore, 80 crore for retirement. And people say, I want to do 100 crore. That's not a necessity, it's an aspiration.
Yeah.
Now, whatever may be the aspiration that you may set, if you work back and see what you're doing now towards that aspiration, you can validate your position very neatly and tell whether you know how much you're going to reach, how you're going to reach, what return you're going to get, when the money will come back to you. Everything can be done through a process of discovering how the future will be for you. So that is what you need to basically learn early enough. When you learn that early enough, in every decision to save or invest, you are going to look for alignment.
Okay.
When you look for alignment in every single decision to your end goal, mistakes will stop happening. So your compounding will happen much better, and you will be able to reach where you want to reach. So it's a very nuanced and very precise activity that you need to do. See, there's also one more very important upside to life. The first 15-20 years of your career, your money goes towards your own living expenses. Then it goes towards raising children. It goes towards buying a home, buying automobile, all these things.
Yeah.
But 20 years into your work life, your home may have been paid off. Your cars is not such a big line item. You can always change once in 7-8 years and manage it. Children have probably reached the advanced stage of education or even completed it. And you still are entering the best phase of your earning years, the 40s or maybe late 40s. You are in the best phase. In that phase, your saving rate can be very high and you can take aggressive investment stance because you have completed many other things.
Okay.
And that decade you get is probably going to give you much better compounding. That's the first point. So that gives you more security financially. Then once your children are on their own, the money that you are spending for them is now available with you. You are still earning, but you are not having to allocate.
Yeah.
So where allocation stops, you again have a huge cushion, an advantage. And you can also build a corpus out of that allocation. You can use it to your full advantage. So all these things people must keep in mind. But ideally, if you are fully financially free by the time you are 20 years into your work life, then it's a very good place to be. Because the next 10 or 15 years, you will be doing superior compounding. You will be building a bigger corpus and you already know what to do, what not to do, what to avoid. You know all those things. You'll put it to full use.
Shyam, from what you are saying, it looks like, a retirement portfolio should majorly or fully be in equities to benefit from compounding, which will beat inflation and also give you that kicker. Now, essentially, when we do our webinars or interactions, we do find people asking us, even for a 1 crore portfolio, we do find people asking us whether mutual funds alone are enough, whether you need PMS or direct equities. And one more question is also about, most of us have compulsory EPF savings, which also go into retirement kitty. And some of us might have NPS savings because erstwhile we had a tax reduction and a lot of us were encouraged to put monies into that. Now, in an EPF or even in an NPS per se, it is not fully allocated to equities. So, how should a retirement portfolio look like, an ideal portfolio?
See, I didn't mean to say that you must only invest in equity. That's not my point. People like me chose to invest predominantly in equity because we felt the compounding impact on our lives will be way superior if we chose to stick to equity. But even if you took debt, let's say you take 15 to 25% of debt or maximum 35% of debt, you still will make returns that beat inflation comfortably. But in debt, you make sure that the instrument is liquid at all times. Don't put money in a place where people are not in a position to play. If they're not in a position to pay, then you are going to be in trouble. So that is something that you need to be very careful. I'm perfectly okay with you investing in debt, investing in InvIT, investing in REIT, wherever you want. But it should come in handy for your retirement.
Okay. And there is also a lot of myth about, equities being risky for a post-retirement portfolio and all that. But, as we know that life expectancy and the lifestyle expenses, equities, some portion of the portfolio, if it is in equities, it's definitely going to help. So how will you play equities for a post-retirement portfolio?
You have retired. Now you have a corpus. Now where did you put that money? You are going to put that money in a place where you want reasonable capital safety. You don't want permanent loss of capital first. You want return on capital and return off capital. You want certainty on both, reasonable certainty. Now, if you put equity and equity goes down like you saw in 2020, suppose somebody retired in December 2019 and he put in equity, what will be his mind state in April 2020? This is the question. Because this kind of situation keep coming back again and again. Even now we will get one mini black swan like that. I would think that the investor should manage this in a way in which such events don't bother him. For example, always you keep 3 years of monthly expenses outside in a low risk investment, like maybe an overnight fund or arbitrage or whatever. So your money for home expenses, living expenses will come to you on the first, like clockwork. Rest of the money you can have a asset allocation and still continue to have maybe about 50 to 65% of equity. There's no problem. Within that, you can choose to have a mutual fund, you can choose to have equity shares, you can have a blend of all, you can do index. It's entirely up to you. But that composite which you are investing has to grow at a reasonable pace, beat inflation persistently, and then be available for you again when this 3-year cash goes down. You have to again top it up. And your corpus should also grow. So you have to strike that balance. So this is how I think you should approach post-retirement investing and personal finance management. This is how we should do it. So when somebody comes with retirement corpus, I immediately tell them 3-year money, I'll put away, you'll get reasonable return, but you'll get the money month after.
Makes sense.
Let's see what happens to the other capital. So that way, the investor is giving time for his investments. He is patient. In a time like this, he doesn't lose his confidence and conviction. It's very dangerous actually. Because that could lead to permanent loss of capital. So you have to be very, very careful in what you do, how you position yourself. And with the client, you have to understand the client and position yourself correctly for the client. It's important that you are correctly aligned to what is good for him. So don't say, oh, you can put all in equity without having this safeguard of money coming every month. Because if the equity portfolio crashes, then your investor will not be able to take money out 1 month.
No, I think the risk is more about people deciding to put everything in debt.
Any asset class. Even in debt. For example, you have this very popular bond craze in India. 2-3 issues. First, is your bond market priced for very rapid change in direction on interest rates? Answer is no. So, in that scenario, relying on bonds for your passive income, relying excessively on bonds can also bring an investor to grief. Very clearly, I am very clear about that. Because the liquidity which you need in your portfolio has to be absolute and uncompromised. So you always choose investments based on that. And within the broad framework of mutual fund investing, choose certain parts which you are comfortable with, assemble a portfolio and move on it.
So in India, there is this thought process of leaving behind a legacy or leaving behind a corpus for the family and the dependents and so on. Now, so essentially people don't erode into their retirement corpus, but they only live off the income. So that has been the concept. For many families, I think it's still leaving a legacy still continues to be important. But on the other hand, we see demographic and economic indicators where you see a lot more dink couples. Recently, we had this, the TFR falling below replacement level in India, which means that you may not have an immediate family to leave your legacy behind for. Of course, you could do things like charity and so on. But these two approaches seem to. At least the second approach probably looks like it'll take mainstream going forward. So how do you plan a corpus when you don't want the corpus to be left over, and how do you? Is it
So
going to be
there are a lot
different?
of people who have children,
Mm.
whose children tell them nothing for us. You
Okay.
live well.
Okay.
Correct?
Mm.
Even they have a peculiar problem that they assume that this corpus is enough because our children don't want our support and live a certain lifestyle which inflates at a rate faster than the corpus is growing.
Yeah.
So suddenly they actually run out of money at 85 and 90
Oh, okay.
because longevity is so high.
Yeah.
In the 80s, they run out of money because they have not estimated the cost of living to go up like this. So whether you are a double income, no kid family, whether you are part of a generation which does not have to leave anything for the next generation, and parents have also told that you don't have to take care of me. So both generations have released you from the burden of managing finances for them or managing their expenditure. Even then, I think that you should have a reasonably active approach to building retirement corpus. You should be ahead of what is your benchmark return that you're trying to get. And you should play safe when you know that market sentiment is overstretched. And you need to be invested adequately in equity as an asset class because that's what will give you the real growth. So you can't say I'll put all my money in FT because you're scared. That option is not there. Then you won't have enough at the later stage. You might as well risk and buy equity responsibly, grow equity responsibly, and create a reasonably sized corpus, which will always feed your monthly expenditure.
Okay. And when we talk of retirement planning, you also spoke about financial freedom. So this FIRE aspiration is there among a lot of people. Now, you are an example of somebody who achieved FIRE quite early in life and still continue to slog. That is a different story. But, what do you think are the things you did right? And more importantly, how did you achieve FIRE despite making certain mistakes if you did?
Well, there are a lot of mistakes you make because you see, in every market cycle, investors like us used to get hammered because we're taking high risk. But there are some interesting things that happened in my life. For the first 10 years of my life, nobody was willing to give me a car loan because I was self-employed. Those days, not available. Similarly, home loan also nobody gave. So I always built my corpus for everything. So I bought my first car with my own money. The first home I bought was entirely paid by me. No loan. Because I built the corpus and just bought it like that. What happened later, at that time I was feeling I was being discriminated. That, oh, these guys are giving salaried guys so much, but they're not giving us anything. This was the feeling at that time. Felt very discriminated. But when you saw it 10 years later, actually felt very happy. Because money, instead of going towards interest, the first 10 years of my earning life, went towards compounding. So the reverse happened to what others were having. As a result of that, compounding did better also. And FIRE happened earlier than it happens today for people. And then I was able to think of something higher for the next 10 years. And in the next 10 years, my income also increased. And by the time, I didn't need a loan for anything. So I kept interest as a component of my personal income expenditure account very low until I reached FIRE. Keeping interest component low, no one knows today. You ask all our young people to tell me last year how much interest they paid. How many people will be able to say it? On their PL, personal loan, on their auto loan, on their credit card balance, if at all they did, on their home loan, on any other miscellaneous loan they took. Can you give me one statement which tells me how much money you spend totally on interest.
Yeah.
If you eliminate that and you're very self-aware, the first 10 years you keep it low, then what happens? Your corpus builds significantly and then money starts working for you. And after the next 10 years, you will find that you don't have anything to worry.
Yeah.
It's a playbook actually.
Yeah.
For me, the fact that I was self-employed turned out to be the biggest blessing. Nobody is giving loan. I still remember an instance where my dividend income was 40 lakhs. I wanted a 10 lakh loan to buy a small office. A home finance company refused, saying dividend we won't take into calculation. I was so sure I can repay it, but they refused. So I just sold some investment and bought that office.
Yeah.
So the fact that interest was a very, very low component in my life in the first 10 to 15 years of living, my personal income expenditure account, interest was very low.
Okay.
That was the biggest thing that helped me achieve FIRE.
Understand.
And after that, it didn't matter whether you borrowed money and invested, borrowed money and bought a house or car or anything, because once you go above a certain threshold, your personal income and expenditure statement has the capacity to service it.
True.
One mistake I made is that I made these private investments at 25. Those days, it was a lot of money. I invested in some private companies. 25, 30 lakhs of money. I think 15 years later, I got 9 lakhs back. I am blessed because those investments failed. Most of these investments. So what I learned was that return of capital is more important than return on capital in illiquid investments. Today also, that is my opposition to bonds. I'm scared. I feel that if your money won't come back automatically to you, or there's a risk of that money coming back to you automatically, or you will be not able to sell that asset at its fair value whenever you want, or that asset could be mismanaged in such a way that the fair value doesn't get created. All these things are a risk. And I was quite aggressive when I did this. I didn't see that it can go wrong because I was only seeing the upside. And this was my 20s. But subsequently, you will be shocked. For nearly 20 years, I didn't go anywhere near private investments. After that, nearly 20 years. That scar was so deep that I was too scared to put money in private investments. So that was a big mistake at that time. But that lesson, 20 years I was thinking was when I again went back into private investments. I think I was more mentally mature, sober and prepared. My diligence was also adequate. And then I built an ecosystem to do that. It's not just me. A lot of people who are with you, who say we can do this, who can't do this. This is okay, this risk is suitable to us, this risk we can't take, this guy is somebody whom we can back, this person you should not back. There's so many questions. Those questions I raised and answered 20 years later because I failed to understand it in the right perspective when I was 25. So that's how mistakes happen, and that's how that mistake is taken into your life in the future to do something better in the same place also. So it's a mistake, but that mistake taught me something which was leaving me scarred for 2 decades, and then I overcame that and I started investing again in private investments. So it's not bad to make mistakes, but it's better to avoid them if you look at it. I'll tell you the big pain point. The 25 lakhs which I put in private investments, I put it at a time when HDFC Bank was trading 25 rupees. I could have bought 1 lakh shares. And you can imagine how much money I would have made. Okay, I know a lot of people do this on WhatsApp. But still, you can't help thinking what a stupid guy you were at that time.
So essentially your playbook to FIRE is, keep your lifestyle, much more frugal. Don't borrow beyond your capacity. That's
live
what
well, but don't live in a way it doesn't leave enough for the future. And keep interest as a component of your income and expenditure account. That's your personal P&L. Keep interest as a very controlled component. I'm not saying don't have interest, but let's say you're buying a car loan, pay it in 3 years. So interest comes down. Let's say you're buying a home loan, try to pay it in 7 or 8 years. Your interest comes down.
Yeah.
Put your principal 50% into it. Your interest comes down.
Mm.
So, in line with the times, I'm not saying live like me, don't take any home loan or car loan. But in line with the times, you develop your own playbook, your own model, which helps you keep your interest down.
Okay.
And you also avoid mistakes. That's very important. That's very, very important. In your personal finance, you have to avoid mistakes. A lot of people are very cavalier, they're very, very reckless, I would say, when it comes to dealing their personal finance, because you think that saving has to be invested to prove a point to whoever. I don't know who they're trying to prove it. That aggression is something that can bring us to a lot of grief. And that aggression is very high today. Option trading, there's so many things people are doing. All of these things will actually risk return of capital. So never do that. That's something I always think. At least I got a part of my capital back. But there are instances where some companies just went away, vanished. You know about it. So those things are all things that you need to think about as an investor, and you need to be very careful in thinking about your retirement when you do all these investments. Otherwise, you will be reckless. Why this focus on retirement is useful is that you will be very purpose driven in building a big corpus.
Correct.
Just think about this, and I'll close with this. You thought of building a corpus of X. You did your compounding so well for 20 years that you built 4X. It's possible. What quality of retirement you will enjoy? What quality of life you will give yourself post-retirement? And how your self-esteem would be at that point, how your social standing would be, and how mentally free you would be. If you have all this, just imagine you won't have to worry about longevity. You will enjoy longevity in a very positive sense.
True.
You don't have to worry about inflation, which is what people scare you about every day. This money won't be enough. This money won't be enough. So if you fashion your life for 20 years like this, after that, I think you will be a very, very different person from all these people who are easily scared by a YouTube video.
True.
Right? It's a very sad state. And nobody should be able to do this to you. I was never scared that I would not be able to create enough money for my retirement. I think that's something that everybody deserves to enjoy. And you can get to that point only if you are very careful. If you're reckless with money and you're trying to be egoistic about doing things in your life, then the price for that recklessness is your future financial freedom. It's very clear. So that's the lesson that I learned in my life. And that's what my mistakes also taught me. And I think that it's important for everybody to avoid making mistakes to the best extent possible. A salaried person should avoid making mistakes. That's what I think.
A lot of interesting behavioral aspects did come out in this conversation on retirement planning. The bottom line, save as much as you can, but more importantly, compound your savings effectively. Don't shun equities post-retirement, and don't put yourself in a situation where you will have to compromise on your lifestyle till you live. Thank you for watching. See you in the next episode of Decode.